There are lots of very popular indicators when it comes to trading and trying to figure out which way markets are going. So in this video, I'll talk about one of the more popular, the theory behind it, and how we can apply it in the real world. In this video, we'll talk a bit about the MACD. I thought we'd start things off just by having a look at what it looks like for those of you who aren't familiar with it. So here is MACD. This is the price of gold. It's a daily chart we're looking at. You can see that the various, the couple of lines on the MACD, various buy and sell signals being generated in here. I'll talk about these a bit more. Plus we have the histogram down here as well that can give us an extra dimension of insight as to what's going on with the MACD and the market we're looking at. And finally, a different twist on how to use it rather than just the straightforward buy and sell. So I'll talk a bit more about these points now, then we'll come back and look at it in more detail. Hello, I'm David Jones from Capital.com, and I thought we'd do another of our series of trading education and trading strategy videos. So we'll look at the theory behind a popular indicator, take a look at it actually in the real world, and a different twist on how we can use these sort of indicators. As usual, if you're watching and you're not subscribed, if you could click on subscribe, it helps support the channel, and it means we can continue to push out lots of different videos on markets during the week, and also the occasional strategy video like this. So let's get into it. Let's start talking about the MACD indicator. So MACD stands for Moving Average Convergence Divergence. A bit of a mouthful, but what it tries to do is combine the principles of moving averages, using those in trending markets, with some basic oscillator principles as well. So really trying to combine two different approaches and melt it down into one indicator. With the MACD, when we're looking at it on a chart, you'll see in a second, we have two lines. So the faster line is known as the MACD line. That's the one that moves quicker. And that's the difference between two exponentially smooth moving averages, usually 12 and 26-day moving averages. The slower line is referred to as the signal line. And this is usually a 9-day moving average of the MACD line. So it's a smoother version of that first line. And put simply, when it comes to generating buy and sell signals, in its simplest format, we get the buy and sell signals when these two lines cross over. And I'll go through some examples in a second. We also have, as part of the MACD, the histogram. And the histogram just plots the difference between these two lines and also shows when these two lines cross over. So some people may use the histogram as an early warning of a signal about to happen. But let's take a look at all of this. Let's jump back and look at it on some real markets. So here's our MACD on the gold chart again. So in its most simplistic format, what we're looking for is the lines crossing over. So if we go back to the most recent signal, you can see it at the bottom of the chart here, and just zoom in and walk through what happened. So we can see the price of gold sells off. This is November into late November 2020. The price sells off. The MACD is, of course, falling, but it gets to a point where perhaps this weakness is running out of steam. And we see the MACD hook over, the two lines cross, and there is our buy signal. So it occurs on this point here on the chart, around about 18.40 an ounce on gold. It did move about $30 higher from there. It sold off at the time of recording, but that's our simplistic buy signal. If we go back to an extreme and pick up on the sell, here we go. Mid-August, when gold had pushed out to fresh all-time highs, sold off for a couple of days. And then we have the crossing over again of these two MACD lines generating the sell signal. We did see the price of gold under pressure for a few months after that. And when it comes to the histogram, once again, let's look at the more recent buy signal that we've had. So you've seen the buy signal occurred on around the 3rd to the 4th of December. That's when the two lines crossed over. But if you were watching the histogram, you can see there were a couple of days when the histogram was getting closer and closer to that zero line for the MACD. So again, some people might use that to try and anticipate the crossing over of the line. So to get something of a head start rather than waiting for the absolute crossover of the MACD. If we go back to those highs from August, we can see a similar sort of thing happening here where everything still looks positive. The gold price makes that all-time high. Then starts falling back. Our MACD lines are falling but haven't crossed. But of course, our histogram is already falling for a couple of days before we finally get the sell signal. So the histogram can give us, again, something of a heads up of a signal about to occur. It doesn't work all the time, but I think using it together in conjunction with the trend and support and resistance, then MACD can be an okay indicator when it comes to generating buy and sell signals. I'll talk about a different way of using it now, then we'll come back and look at things in a bit more detail once more. So we've looked at a simplistic approach with using the MACD, but we also have this idea of bullish and bearish divergence. And I talk about this occasionally when we're doing our regular market videos, when we're looking at the RSI. And the principle is the same with a MACD, because indicators, all they're doing is taking the price data, applying some calculations and showing it in a slightly different way. Broadly speaking, the indicators should follow the trend of the market. And it's when this doesn't happen is when we have divergence. So bullish divergence occurs when we have a market that's sliding. The market hits a lower low, so the trend downwards is continuing. But our MACD, in this example, makes a higher low. So the MACD is diverging from what's going on with the price action. This can be a buy signal. The flip side of bullish divergence is bearish divergence. The market's pushing higher, makes a higher high for the move, but the MACD doesn't follow. So the MACD makes a lower high. This is known as bearish divergence and can be used as a sell signal, can suggest that the uptrend is running out of steam. Because these signals don't happen that often, I do think they're worth paying attention to. So again, let's have a look at bullish and bearish MACD divergences in a real market. So I've changed the market we're looking at just to look at this idea of divergence. And it's quite an extreme one, but it does illustrate the point. Though this is the oil price. So we're still on a daily chart, and we can see in March of 2020, the oil price, this is West Texas crude, hits a low of about $20 and then rallies back up to 32. So a sizable move. The MACD has understandably moved to an extreme as well. Then the price of oil lurches lower still, but so we have lower lows on the oil price, but we don't have it on the MACD. So our MACD has actually made a higher low. So when we're talking about bullish divergence, this is what we mean. The market slips to a new low, but the MACD is making a high low. So it can be a suggestion that perhaps the weakness is running out of steam. And of course, this was the case. I suppose the aggressive trade here would perhaps have been a buyer when the MACD line crossed over with a stop under the more recent low. And of course, then we did ultimately see the price of oil bounce back. And here's a different market again to illustrate the idea of bearish divergence, where a market gets to a level, pushes higher, but the MACD doesn't follow through. So this is pound against the dollar. So pushed to a high in early August 2020. MACD is at an extreme as well. So far, so good. And then into the end of August, early September, the pound against the dollar pushes higher again. But look at what's happening with the MACD. We've got a lower high on the MACD. So again, it could be a suggestion that even though the trend on the face of it looks okay, the MACD is saying that perhaps it is starting to falter. So again, I suppose if we took the sell signal here on the 3rd of September, stops above that most recent extreme, it would have been a very profitable trade. So there's an example of bearish divergence using our MACD. That's it for the latest of our trading, education, and strategy videos. I hope you found it useful. So from me, David Jones and Capital.com, we'll leave things there. For more trading videos just like this, please subscribe to our channel.